Good afternoon, everyone. Thank you for joining us for the press conference to inform you about the Eurogroup meeting we had this morning. I'd like to debrief you of that meeting. We welcomed Reza Moghadam from the IMF, as well as Rimantas Satsius, Finance Minister of Lithuania, as well as ECOFIN President, of course. He attended our meeting when we discussed the banking union. I'll come back to that later on. I will start with this economic situation in the Eurozone, then go into the situation in Cyprus, Portugal and Slovenia, which we discussed, and finally say a few words about the banking union. On the economic situation, we discussed the latest developments in the euro area, which, as you know, have been fairly positive. GDP increased by 0.3% from the first to the second quarter this year. And in August, the economic sentiment indicator increased, almost reaching a two-year high. After having climbed in the last 2 years, the unemployment rate in the euro area has now stabilized since March at around 12%, which is, of course, still too high. It's too early, therefore, to be complacent. We need to carry on with all our policies with resolve, and that's what we're going to do, in particular with strong priority the banking union, but also the closer coordination of our budget policies. In this context, I intend to convene an additional Eurogroup on the 22nd of November to discuss for the first time the Commission's assessment of the country's draft budgetary plans. So in November we'll meet twice. On Portugal, we briefly discussed the situation in Portugal, where there are also positive signs both on the economic and on the political front. We welcomed the above euro area average GDP growth in the second quarter in Portugal and the reaffirmation of the political consensus within the coalition supporting the program in the new coalition agreement. In this regard, we were again reassured by our colleague Maria Luís Albuquerque that the government is fully committed to the program. A rigorous implementation of the agreed policy conditionalities will ensure a long-lasting economic recovery. We intend to discuss the main findings of the merged 8th and 9th review mission that will go to Lisbon next week, and we will discuss their main findings at our next meeting on the 14th of October. We discussed the first preview of the Cypriot program. We've put out a statement which hopefully you already have or you will have after this press conference. I won't repeat all of it that was in the statement, but just to highlight some of the points. Progress has been made over the summer, including the exit of the Bank of Cyprus from the resolution process. A roadmap has been agreed for the gradual relaxation and eventual abolishment of the administrative measures regarding capital flows. Policy implementation, of course, remains essential for the success of the program, as the economic outlook remains uncertain. We look forward to the implementation of the anti-money laundering action plan, and the 1.5 billion euro, this is the second disbursement, will be disbursed by the ESM following the completion of this review and the formal approval in the ESM governing bodies. We also discussed briefly the state of play in Slovenia. Asset quality reviews and stress tests are ongoing for 10 banks, including the major ones, and are expected to be completed by the end of November. 2 banks, the Slovenian government has already started the orderly winding down process for 2 smaller banks last Friday. And we stress the importance for the Slovenian government to work with and seek the cooperation and assistance of the ECB and the European Commission in the process of dealing with the problems in the financial sector. Finally, we talked about the banking union. Not in depth, we didn't go into great substance at this moment. We were informed by the ECB on their preparations of the SSM, especially regarding the balance sheet assessments of the banks, which the ECB will start up very soon. Jörg Asmussen will say more about that. And we all stress the importance of doing that in a very rigorous and transparent way to strengthen our banks, which is of a great importance for economic recovery. We looked ahead of the agenda over the next couple of months, and also, of course, the cooperation between Eurogroup and ECOFIN, the main issues, of course, being discussed in ECOFIN. And we look forward to strengthening our cooperation. We welcome the final adaptation of the regulations for the establishment of the SSM, the single supervisory mechanism, by the European Parliament yesterday. And this will allow the ECB to formalize the preparations of their work as a supervisor. We had a first exchange of views regarding the appropriate arrangements to be made ahead of this, the completion of this exercise as mandated by the June European Council. We will come back to the issue of public backstops over the next couple of months and discuss it in detail in our planning for November. We hope there will be also a swift agreement with the European Parliament on the Bank Resolution and Recovery Directive, the BRRD, after which we can then again in the Eurogroup finalize the operational framework for the ESM direct recap instrument. So work on all the legs of the banking union is on track. The single resolution mechanism will be discussed mainly in ECOFIN, but over the next couple of months also a number of details which touch upon the Eurogroup interest will be discussed in the Eurogroup. I would just like to end with a word of gratitude to Rimantas and all his colleagues at the Ministry here in Lithuania and the Central Bank for hosting the Eurogroup today. Olli, can I ask you to fill in from your point?
Thanks, Jeroen. Ladies and gentlemen, welcome on my behalf as well, and I can say that I'm very glad to be back in Vilnius. I was in Riga yesterday in Latvia, preparing ground for the euro adoption of Latvia on the 1st of January 2014 in a conference with President Mario Draghi and some other colleagues. Maybe next year we will have the same kind of conference in Vilnius. Of course, that will depend on whether Lithuania will be able to meet the well-known conditions of acceding to the Eurozone. Anyway, as a long-time supporter of the Baltic states' integration to Europe, I'm glad to note that these countries, Estonia, Latvia and Lithuania, have recovered well from the crisis and are growing robustly. I believe that this is a testimony to the enlargement of the European Union as a force of peaceful economic and democratic transformation of our continent. Concerning the European economy overall, the summer has brought encouraging signs that the European economy has reached a turning point. The second quarter GDP figures were somewhat better than expected, though pretty much in line with the Commission's spring forecast. And in line with that, a gradual economic recovery is taking root in Europe, which we expect to grow firmer in the coming months and stand on a more solid footing and pick up speed in the course of next year, 2015. 2014. But certainly this is no time of shouting that the crisis is over. That is clearly premature. And I see that the key risk is to this recovery is complacency. Complacency in policy and complacency in terms of reforms. And complacency is a luxury that we simply cannot afford. Unemployment remains at dramatic levels in some countries of Southern Europe. Many households and businesses, especially SMEs, are still struggling to obtain affordable credit. And therefore, much more needs to be done to remove the bottlenecks of economic growth that are holding us back still for the moment. That's why it is essential to stay the course of reform and in some cases step up the reform of our economies for sustainable growth and job creation. In this regard, we have 3 months of very intense work ahead of us, both in the member states and at the European level. By the beginning of October, those countries which received new Council recommendations in July to correct their excessive deficits must take the necessary effective action to comply with those Council recommendations. They also need to concretize their plans for fiscal structural reforms. And by the 15th of October, by mid-October, euro area countries must present their draft national budgets for next year for scrutiny to the Commission and to the Eurogroup. In November, the Commission will present a concrete, detailed assessment of all those policy measures, also taking into account our autumn economic forecast. According to the European law, our responsibility is to scrutinize and make sure that the member states, the EU member states, especially the euro area member states, practice what they preach in terms of economic and fiscal policies, in terms of fiscal policies and structural reforms. And that is for the sake of the sustainability of public finances and for the sake of sustainable growth and job creation. I would also like to provide you with some further guidance on the Eurozone's transition from crisis management to post-crisis management and post-program arrangements. In the coming 9 months, the programs in Ireland, Spain and Portugal are due to conclude. As you know, we also have important decisions to take concerning Greece. I can tell you that there will be no single rule or uniform pattern to be followed here. We will need to look very carefully at what the optimal solution will be in each case to ensure a successful exit. What is clear is that the objective in all cases will be to ensure financial stability, to strengthen economic recovery and to enable successful program exits for the countries concerned. And our intention is to prepare the necessary decisions together with our partners in the Troika, and of course within the frame of the Eurogroup, so that these decisions can be taken in good time. Finally, a word on the 5th anniversary of the collapse of Lehman Brothers, which tipped the world economy into the worst crisis since the Second World War. The financial crisis was not an act of God. It was the result of action, or sometimes inaction, by policymakers and financiers in Europe and the United States. It was the outcome of a series of risks that were underestimated or completely ignored, and of imbalances that were allowed to develop unchecked until it was too late. It was, in short, a triumph of hubris over prudence. I believe we have learned many lessons from that crisis, and we are much better placed now to avoid finding ourselves in such a predicament again. Globally and within Europe, financial regulation and supervision have been significantly strengthened. Who would have thought in 2008 that we would now have agreed on a single supervisory mechanism? And who would have thought then that we would have reformed and reinforced our economic governance of the Eurozone to the extent we have done? But we must never lower our guard, policymakers in national capitals at the European level and in global forums like G20 and the IMF must remain vigilant so that the experience of the great financial crisis of September 2008 remains where it belongs to, in the history books. I end here. Thank you.
Thank you. Jörg Asmussen from the ECB.
Thanks. Yeah, first I was pleased to hear that also the Commission now applies the concept of forward guidance. I share most, not to say all, what Jeroen and Olli said, so I will focus from our perspective on the banking union, because this, in our view, is the biggest integration step in Europe since the introduction of the common currency. And as you know, we at the ECB, we very much really welcome the adoption of the SSM regulation by the European Parliament yesterday. And we now look forward to the final adoption of the regulation by the Council, because then we can proceed with the establishment of the Supervisory Board, including the Chair and the Vice Chair, because we need the Supervisory Board to take a number of essential decisions to move forward. You are aware we have concluded between us, the ECB, and the European Parliament an interinstitutional agreement on the accountability of the SSM. This is key that we ensure a high degree of accountability, because banking supervision in this respect is different from monetary policy. And we have now reached an agreement that assures this high degree of accountability while at the same time safeguards the protection of confidential information. And the preparations for the single supervisory mechanism is well proceeding. We have made sustained progress over the summer, and we will be ready to start the operation of the SSM in the fall next year. This is an ambitious timetable, but it's a doable one. And we have advanced the preparation in 4 areas. The first one is that we are developing a supervisory manual which describes the procedures for cooperation within the SSM and with the authorities outside the SSM. Second, we are preparing the supervisory reporting, which will harmonize how data are collected within the SSM, and we have created a template here which is now tested in a pilot case with pilot data. Third, we are preparing the implementation of the SSM framework regulation, which will include the methodology for the identification of significant banks. This framework regulation will be put forward to public consultation in the fall of this year. And the fourth area of preparation, which catches the most attention for the time being, is the balance sheet assessment that will take place of all those banks that will be directly supervised by the ECB. As you know, it will have a number of elements. It's mainly a balance sheet assessment followed by a stress test. And in our view, the importance of this exercise can be hardly overestimated. because it provides an extraordinary and overdue opportunity to create transparency of bank balance sheets in Europe, and if necessary, to repair this bank balance sheets. For a number of reasons, 2 stress tests in Europe failed to create this transparency and to repair the bank balance sheets. And this is now our 3rd and maybe our last chance to do this. And this is, in our view, of key importance, because without such a repair, a revival of credit provision by the European banking sector, which is essential for regaining growth, will simply not happen. And these are the reasons why, in our view, the asset quality review and the stress tests have to be rigorous, robust, because the aim at the end is to have a banking sector that is able to lend to the real economies at levels that we would like to see it. It might be the case that this exercise requires recapitalization, and it has to be clear before the exercise starts how one can deal with these possible recapitalization needs. The first line of defense, of course, are private markets. But there might be cases where that is not sufficient. And it has to be clear that additional backstops then are provided. This, in first line, will be national budgets. And if circumstances require, these national backstops may be supported by an ESM financial sector program to an individual member state, as we have seen in the past in the case of Spain, which was very successful. And I noted gladly that the chair of the Eurogroup has said that he will come back to the topic of backstops at the November meeting of the Eurogroup. To conclude, the second aspect of the banking union where there is no time to lose is the single resolution mechanism. We at the ECB welcome the Commission's proposal for a single resolution mechanism because the crisis has shown that coordination among member states has been inadequate to organize the resolution of cross-border banks. And this means we want a single system, a single authority, and a single fund. And we strongly support the timeline that is envisaged by the Commission, means the 1st of January 2015. And it's our understanding, my understanding, that the opinion of the Council Legal Services formally confirms that Article 114 is sufficient as a legal base, including for establishing a single resolution fund. And this is also the view of our legal service at the ECB, that Article 114 is indeed a solid and robust legal base. That means we see now a consensus among the legal experts of the Council, the Commission, and the ECB, and this should enable us to move forward. Thanks.
Thank you, Jörg. Klaus?
Yes, thank you. A few words from the ESM perspective. First on countries, Cyprus. The President talked about it. The Eurogroup also met as Board of Governors of the ESM at the end of the Eurogroup meeting to approve the revised Memorandum of Understanding. That's the basis for our Board of Directors to approve a disbursement next week, and then we will do that before the end of the month. With that disbursement, which will be €1.5 billion, the ESM will have given to Cyprus €4.5 billion, which is half the program amount coming from the ESM. Portugal, the review mission will start next week. For Portugal, there are €5 billion left to be disbursed from the EFSF between now and the middle of next year, and the mission, of course, will be crucial to determine the phasing of that. More generally on EFSF and ESM lending, as I have said a few times in these meetings, we have disbursed more than 210 billion euro, 210 billion during the last 2.5 years. Unlike other lenders, like particularly the IMF, we have to go to the markets first to mobilize these funds. It's important to realize that EFSF and ESM will continue to be in the market. Both institutions will be in the market for a long term, in the long run, because the EFSF has to roll over outstanding claims on Ireland, Portugal, and Greece. And you know these programs run between 22 and 30 years, so we have to roll over our outstanding claims. The ESM will be at the same time in the market. So far, ESM has only issued short-term bills. In October, and that's an important moment for the ESM, we will issue our first long-term bond. Thank you.
Thank you, Klaus. And I'd like to give the floor to you. I see a couple of hands on that side. Well, I see hands everywhere. Do we have are you using microphones? Is there a microphone walking around? Ah, there you are. Then you can decide who comes first. My advice for you will be to hold on to the microphone, because otherwise you'll never get it back.
Jean-Jacques Mevel, Le Figaro. Question on France, no surprise. Your two neighbors, Mr. Rehn and Mr. Asmussen, have been quoted in the last hours or days saying that reforms in France are not going fast or deep enough. Just want to know if you share this view, if the question was raised or even discussed during the Eurogroup, and if Mr. Moscovici was given any chance to answer.
Yes, when we discussed the economic situation, a number of colleagues informed us on the progress being made in their country, in their political situation, both on budgetary measures as well as structural reforms. Pierre Moscovici informed us on all the measures being taken in France. It's not up to me to judge at this time whether progress has been made enough. As a matter of fact, that's the responsibility for the Commissioner to judge at the right time. So possibly Olli would like to fill in on that, but that will be my position. At this moment, we've simply taken stock of the situation in a different number of countries on progress being made, including France. Want to add anything?
Just to say that I stick to the words that I have said before in recent days. I find it very important that we recognize that France has started a very substantial process of economic reforms, but at the same time there is much more to be done, especially to restore the cost competitiveness of France, which implies improving labor costs in France for the sake of sustainable growth and job creation, which is what the French people are indeed expecting. We work in good partnership with the French government, and we continue to do our job, which is to be responsible for surveillance, monitoring of economic reforms in France, like in any other country. And we will come back to this in October, November, once we have received the draft national budget, and we can assess the fiscal structural reforms more in the course of November. That we will do for all Euro area member states and, in fact, all EU member states.
As you know, all the countries have to send their draft budgets to the Commission on, I think, before the 15th of October, and then the Commission will give their assessment by the 15th of November, and that's why we will have an extra Eurogroup on the 22nd of November to then talk about the budgets, draft budgets, as well as the Commission's assessment of the targets and the results. Yes, please.
Yeah, now it should be working. Giovanna Pancheri, Sky Italia, gonna continue in this line, but my country is Italy. So this morning as well, you were talking about your worrying on Italian political situation. I want to ask you if Mr. Saccomanni told you something about Italian situation during the Eurogroup. And to Mr. Rehn, yesterday the ECB in his bulletin said that Italy is risking not to reach its budgetary objective on the deficit target. So do you share this kind of worrying on the budgetary target as well? Thank you.
This morning, the only point I made, and I can make it for a number of countries, is the importance of political stability. If we want to push forward, and we have to push forward in dealing with budgetary problems, in dealing with structural reforms, political stability is of the foremost importance. That regards almost all the countries, I'd like to think, even my own country. So also Italy. Mr. Saccomanni briefed us today on the progress he's making in Italy. And the same would apply for what we just said about France regarding the further process in October and November. Anything from you?
Just to endorse what Jeroen said, political stability is essential for economic recovery in Italy, as in other countries. And as regards your specific question concerning Italy meeting its fiscal targets, Prime Minister Letta and Finance Minister Saccomanni have very clearly underlined their commitment to ensure that Italy will meet its fiscal targets and thus avoid being brought again back to the excessive deficit procedure. I trust that the Italian government will ensure that this will indeed happen, because it is essential for the sustainability of public finances in Italy and for returning to a sustained recovery of growth and jobs.
Jürgen Betz, Associated Press. Question for you, Mr. Asmussen. You said very unequivocally that from the point of view, from the ECB's point of view, the legal basis for the SRM is sufficient. My question is, how did German Finance Minister Schäuble receive this clear message? Because the Germans keep saying, no, you can't do it on the treaties.
I mean, I have not discussed this with my former boss during the meeting this morning. I just was quoting what the Council Legal Service has put forward. And this is a formal confirmation that Article 114 is a sound legal basis. And this is in line what is our view at the ECB. We will come up with formal legal opinion. This is what we have to do for the SRM. This will come soon this fall. But without telling you too much right now, it's indeed our view that Article 114 is a solid and robust legal base. So there's a consensus, as I said, among legal experts of the Council, the Commission, and the ECB. And now we can move on, and we should move on the second key element of the banking union.
Let's move over to that side for a couple of questions.
If I could have a clarification from Mr. Rehn. Commissioner, you said that in the next 9 months you will be devising a strategy how to push countries in bailout programs back to the markets if their financial conditions permit. Specifically on Greece, will it take you 9 months to devise the plan, or do you expect after the end of the 9 months Greece could gradually return to the markets? And if I could have a comment from Mr. Asmussen, clearly there are some soft signs that the Eurozone is returning back to growth. Is the ECB concerned about the imbalance between countries such as Italy sticking to recession part and countries such as Germany returning to robust growth?
I referred to the decisions concerning how to ensure a successful exit from the program for countries like Spain, Portugal and Ireland. And I said we will also face important decisions concerning Greece. We all know that for Greece the economic challenges have been of different magnitude, both qualitatively and quantitatively. And we will have to assess the financing needs and the possible fiscal gap and the issues of debt sustainability in good time. I expect that we will now focus especially on the financing needs and fiscal gap in the course of the coming review mission, which will start on Monday, Tuesday next week. And it is at this stage premature to say anything definitive, not to speak to quote any exact figure of what might be the possible further financing needs of Greece in the coming period. So let's come back to this once we have done our job in terms of economic analysis and assessing the financing needs once we have concluded the next review mission, which will start next week, next Monday.
Yes, as regards the growth situation in the euro area, I mean, the incoming data has brought some comfort to our expectations that we will see a very gradual recovery in the euro area in the second half of this year. You know, the real GDP data for the second quarter brought, for the first time since 6 quarters, a positive result. That was stronger than expected. But it was mainly mainly driven by developments in large euro area economies, but we also could observe improvements across the euro area, also in program countries, for example, Portugal. And the increase of the euro area GDP was partly temporary. It was partly due to the impact of bad weather conditions earlier this year. And since these temporary factors will fade away and not support growth in the third quarter, available survey-based indicators confirm our expectation of a very slow recovery. So we see some green shoots, but there is nothing to organize a great party already now.
Perhaps I could say a little more about the different programs and how to move forward with them. There's been a lot of speculation about programs, new programs, exit strategies, and even numbers. And I think it would be helpful if we give you an idea of our planning regarding this discussion. We intend to, on the basis of the 4th review, come back to Spain and the Spanish program in our November meeting, the 15th of November. As you know, the Spanish banking program expires in December. We will also in November come back to Ireland and the exit strategy and what is needed there, also in November. And as Olli said, regarding the present program for Greece, we will take stock of the situation, I think, either in November or December on the basis of the review. Also, the discussion that we've had through the media about financing gaps, we will then look into whether there are any, what the size is, and how to deal with them. So that's all before the end of the year. That gives you an idea how we will move forward with these discussions and decisions which have to be made. And hopefully we will have less speculation and more planning and decision-making over the next couple of months.
Mermelando from the Spanish news agency Europa Press, precisely on Spain. A question for Mr. Rehn and Mr. Asmussen. In your view, what will be the best option, exit option for the program in Spain? Will it be an extension of this program, attending the quality asset review of the ECB, or which other alternatives are you thinking of? And what's your preliminary assessment of the pension reform in Spain? Thank you.
Concerning the pension reform, we are currently assessing it, and we will come back to that in due course. It will be part of our overall assessment, more profound assessment, in the context of assessing the fiscal structural reforms in the course of the coming autumn. As regards the question of how Spain will exit from its program, it is still too early to say. But what I can say is that the financial sector reform program of Spain has been on track and continues to be on track, which is helping to restore the health and resilience of the banking sector and financial industry in Spain, which is a very important foundation for ensuring that credit will flow better to households and businesses, especially SMEs, because this has been the major bottleneck of growth, major bottleneck to growth in Spain as in some other Southern European countries. So that's why it is indispensable, indeed crucial, that the asset quality review and stress tests will be done in a convincing and credible manner, and that the financial sector repair program will be concluded with the same rigor and determination as has been done during its existence so far. This is crucial for the economic recovery of Spain, for the recovery of growth and employment in Spain.
Maybe one more from that side, and then we'll see where we stand.
And this is a question, Suzanne Lynch here from the Irish Times. This is a question for Mr. Rehn, really. Just in terms of the fact that countries need to submit their budget plans to the European Commission, do you envisage that the European Commission will veto any of these plans, or are you in quite close contact with various departments of finances in the various states? And secondly, and connected to that, will there be a link between member states' decisions in its national budgets and plans to exit the bailout? For example, in Ireland's case and in Spain's case, will you be keeping in mind what it does in its budget when you're deciding about support mechanisms for exiting the bailout?
Thank you. You had actually a set of questions, a number of questions. I tried to be concise in my response. First, I see that the reinforced economic governance is essentially based on partnership, which means, as you rightly assume, that we work in close partnership, in very close contact with all treasuries or all finance ministries, all governments of the European Union, especially of the Eurozone countries. That's point number one. My second point is that we will assess the compliance of the draft national budgets in the light of the commitments undertaken by the member states and in the light of the Council recommendations to each and every member state of the European Union. And I want to underline that this does not mean that it would imply any shift of budgetary powers or competencies to Brussels. That's not the issue. The issue is that the Council and the Parliament have given us, the Commission, the task to monitor whether the Member States practice what they preach in terms of their commitments to the sustainability of public finances and economic reforms that support growth and sustainable growth and job creation. That's the purpose of this exercise, and as I said, we will do this with our normal rigor, but at the same time with the spirit of partnership, because that's what the new economic governance is all about.
We can only take like 2 more questions because we have to join our colleagues in the lunch meeting in the ECOFIN. So please. And then the lady over there maybe.
Working? Gabrielle Steinhauser from the Wall Street Journal. A question for Mr. Asmussen. You said that the Council confirmed the legal basis for the SRM. However, it did raise some questions about the financing of the fund, especially in the beginning when there's hardly any or no money in it. It said that actually the proposal needs additional safeguards to protect national budgets. Do you think it's credible to have a single fund without recourse to national budgets? How will it be financed? Can it really just go on the market and raise money? And how can it raise money? What's the basis for that money? Will it have its own capital? Will it have some kind of guarantee from some institution? How's the fund going to work in the early stages? Thank you.
My colleagues having fun that they do not have to answer this question. Thanks. I mean, it's true that the Council Legal Service has made a caveat that an adequate system guaranteeing the budgetary sovereignty of SSM and SRM member states against decision of the SRM has to be introduced. In particular, as you rightly pointed at, during the transition period in which the resolution fund will be built up. And this caveat will need to be addressed by the legislative branches. But this caveat does not challenge in any significant way the proposal put forward by the Commission on the SRM for a single resolution regime, a single fund, and a single authority. And if one, for example, in the build-up phase of this fund needs a backstop, this could be in a fiscally neutral way operating the existing ESM. I mean, it could be, let's say, if in the build-up of the phase there's a need to tap the single resolution fund, which is financed by levies on the industry, and if there is not enough money in the fund, then the ESM, this is in the current situation not possible for the ESM. So it's about talk about the future. The ESM could lend money to the fund, and then later with incoming future bank levies to the resolution fund, it can be reimbursed to the ESM. So there is no permanent transfer from the ESM to the single resolution fund.
Thank you. Beatriz Navarro with La Vanguardia. I also have a question for Mr. Rasmussen. You mentioned that when the asset quality review and the stress test take place, there must be absolute clarity about the backstops at national and European level. In this context, what do you think Spain should do when its financial assistance program ends? Should it go for an extension, or maybe we can think about other kind of accompanying measures? Thank you.
I mean, as the chair of the Eurogroup said, we will come back to the question of Spain in November. So the backstop requirements from our side is not related to any specific country. It's true for all countries participating in the SSM. And as I said, it's first the markets, then the national budgets, then
state aid rules, not to forget.
Yes, then the existing ESM, and in very rare and exceptional circumstances, in unlikely circumstances, the directly banking recapitalization via the ESM. And in the whole exercise, the newly adopted state aid guidelines of the Commission, which foresee rules for bailing in, have to be applied. I understand that there are quite a number of factual questions on the stress test and the asset quality review, and it's our aim that the President of the ECB will go public to answer these factual questions about this key exercise in mid-October.
Okay, thank you very much. We have to leave it at this for the moment. Thank you.